All right, so welcome back to the last section of chapter 5 here. Chapter 11, excuse me. 11.5 and 11.6. Now, 11.5 is going to talk about disposal of assets, okay? Since we talked about depreciation, what happens when it reaches the end of its life? What do you do with those assets? That's exactly what we're going to talk about today. All right. There's many things that we can do, especially when we have these fixed assets, right? Once we purchase them, they're not going to be forever in our books. Eventually, there will come a time where we need to get rid of them off our books because they're either too old, maybe we need to update our, furniture or whatever it is, right? So at the end of the day, I'm going to be showing you what you can do when you purchase those fixed assets and they're either old, worn, torn out, whatever reasons that you want to replace or get rid of it. You have a bunch of options that you can do. So number one would be you could sell your assets, especially, putting it on the market. You can get rid of it off of your books by just dumping it into the trash can. And then, of course, you can also exchange it or even replace the assets. You can including repair, right? If you think this asset's still worth it, the value, or still can be able to push through to continue working, you can even fix it, right? So let's talk about what to do when you have those fixed assets and what do you choose to do with it, because they're not going to always stay on your books forever. Okay, so let's talk about disposal of assets. Okay, how do I dispose a fixed asset? Well, first off, we have to figure out what we have to obviously figure out what the fair market value of my fixed assets are, right? In this case, that's why we have to figure out what book value is, because once we use our fixed assets, it comes with a price, right? It doesn't hold its value. So in this case, we need to figure out two things, right? If I were to sell my fixed asset, whether I sell or whether I discard it, right? I need to figure out, am I taking a loss or a gain? Now, most cases, if you're going to be throwing an asset in the trash, you're taking a loss. But if you're reselling it to someone else, you can figure out what that gain is, okay? So this is very important why we need to have our depreciation tables, because we are constantly calculating our book value, either at the end of the year, at the end of the month. So we are constantly determining what the value of my fixed asset should be on my end, right? And we call that book value. Now, of course, we have to go through an appraisal, of course, to get a true value, but at least we have a rough estimate on our books, right? If we're depreciating it the way that we do, whether we're using units of production, straight line, or double declining, we still have determined what a estimated book value should be, okay? And we're going to be using that to determine whether we made a gain or we made a loss, okay? So let's go ahead and take the steps to go ahead and dispose of fixed assets. So, of course, you got to purchase. You got to look at the purchase price of the fixed asset, right? What did you originally purchase the fixed asset at? Because remember, the historical cost rule will stay intact. So if you had that asset for 10 years, it's still gonna be written as whatever value that you originally purchased it at. Okay. Next, you're gonna be determining the amount of depreciation, right? That you have used the asset, right? And of course, you're also going to be determining, right, the book value. So that's the reason. So number two is because you're looking at how much depreciation you have taken off of the fixed asset, right? That's ultimately going to give you your book value, okay? And then, of course, once you sell or receive a payment, right, that's where you're going to determine, was the value of the payment higher or lower than your book value? If it's higher, you received a gain. If it's lower, you had a loss, okay? So again, then you're going to record everything to get it off your books, okay? So let's go ahead and take an example, okay? So example number 1, on January 5th, you purchased a machine for $50,000, okay, on a credit card, okay? Assume that all the fees and taxes are included, okay? And of course, let's go ahead and record the purchase of this fixed asset. So we bought a machine, right? So we're going to consider that equipment. Excuse me. We bought a fixed asset. We bought a machine. So I categorize as equipment. And since I pay with my credit card, boom. Okay. So there you go, $50,000. So now that is on my books as of January 5th. Now, once I do that, that means the next year or the next month, however I depreciate my fixed assets for, I'm going to start recording that as I use my machine, I'm going to slowly depreciate it, right? So in this case, assuming that we're going to be using straight line to go ahead and record the depreciation for this fixed asset. So again, we plugged our numbers in and we're going to go ahead and start, right? First month has passed. Boom. There's my numbers. It's going to be 20% once again because it's every month. But of course, I have to divide that by 12 to get my monthly depreciations. So in this case, because I divided by 12, right? That's going to give me right here. So $750 per month. Okay. Now that I have already depreciated my first one, now see, this is what I was talking about. Every time you have a cumulative depreciation, right, that's going to automatically help you calculate your book value. So just using my asset for 1 month, I've already lost $750 in value. So therefore, my book value is now at $49,250. Okay. Now, and then of course I have to, of course, record that depreciation because every single month that I do depreciate, right, this is where in my books it starts to rack up all of the depreciation that represents me using my fixed asset. Okay. Now, of course, as I go through the years, right? So then 4 years later, okay? 4 years later, you decided to sell your machine to purchase a new one, okay? And of course, on January 28th, okay, you sold your machine for $10,000, okay? And of course, so let's go ahead and record this, the sale of the fixed asset and determine whether we made a gain or loss. In this case, we got cash, $10,000 cash, okay? So how do I go ahead and determine my numbers? Well, in this case, I originally bought my fixed asset on January 5th, right? I started depreciating as of January. I'm going to sell it as of January 28th. That means I used it for 4 years and 1 month because I'm choosing to sell it at the end of January. That means I have to depreciate it for that last month of January. Okay? So that's exactly what I did here. So right here, we all know for 48 months is 48 months is 4 years. Okay, plus an additional one because we didn't sell our fixed asset until January 28th. Even though we didn't adjust um, our fixed asset at the end of the month, right? Because we're choosing to sell our product at the end of the month, we have to consider if we sold it before 15 days, then you don't have to depreciate that extra month. But in this case, I used it for that extra month. Okay? So in this case, I'm going to go ahead and calculate my last depreciation. So once again, since I'm using straight line, it's going to be the same exact number. So I'm going to depreciate by an extra $750. So right now, my book value is telling me that it is $13,250. Okay? That's my book value. So how do I go ahead and determine this? Well, at least I know this much. I received $10,000 cash. Okay? Boom. My fixed asset was worth $50,000. Boom. Okay? I know that much information. And here's where I have to also think. Well, since I'm getting rid of this asset, right? My asset came with that contra account, right? Because we have to remember, we created that contra account to keep track of the accumulated depreciation. So therefore, if I had to zero out my fixed asset because I sold it, right, for $50,000, I know for a fact it's not worth $50,000. I know it's worth right now currently $13,250. Now, how do I go ahead and record that to make it even? Well, in this case, if I got rid of my fixed asset account, I also have to get rid of my contra account for the accumulated depreciation. So therefore, since the contra account normally is a credit, I'm going to debit my accumulated depreciation. For how much? Well, how much did I rack up for those 4 years and 1 extra month? I racked up a total of $36,750. Okay? So then now I need to determine, did I make a gain or did I make a loss? In this case, I for surely lost money because my book value, as you can see, says that it's still worth $13,250. I only received $10,000 out of it. So therefore, I lost $3,250 out of this sale. Okay? And this is typical, right? Usually, when you do sell your fixed assets, oftentimes you are more likely to take a loss than you were more likely to get a gain. Okay? But that's an example of what happens when we sell our fixed assets and we end up getting a loss. Okay? So that's how we get rid of it off of my books. Okay? So let's take a look at example number 2. What if I had the same exact scenario, right? So my numbers are all the same, but instead of getting paid $10,000, I actually end up getting paid $15,000. Okay, so this is a separate scenario. So instead of being paid $10,000, I got paid $15,000 for my fixed asset. Okay. Like I mentioned, the only difference here is, well, I recognize the cash that I got for $15,000. I recognize that my fixed asset was $50,000. I recognize my accumulated depreciation was $36,750. Now, my fixed asset, right? I know from my books it's $13,250. But how much did I sell it for? I sold it for $15,000. So therefore, I gained money, right? I gained an extra $1,750 from that sale. So in this case, I'm going to recognize that $1,750 is going to be on my right side. Okay. All right, any questions? 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 All right, any questions?
No.
Okay. So, what if I choose that if I believe my fixed asset could possibly be fixed, what happens when I do encounter that? In this case, right? If my fixed asset, right, if you do a lot of things such as restore it, fix it, replace certain parts to the machine, right? Okay? Or do some maintenance on it, right? So as usually appliances go, right? If you take care of the machine and you do its routine where you replace a few parts and things like that, you're adding either two things. You're either adding the cost to it and extending the life of the fixed asset. So that means if you're going to be spending extra money to fix something that's broken so it can work again, the ultimate result out of that is you're adding more value to the fixed asset because you're trying to extend the usage and the life of it. Okay? So here's what you have to know. If you choose to go ahead and make these additional changes or fixtures to your fixed asset, you have two options that you can do. Number one is going to be you're going to take that price of whatever it is that you did to improve that fixed asset and either counter it against the accumulated depreciation, or number two, you either add that value to the equipment. Okay? And I'm going to show you two examples today because those things, right? You're adding value to the fixed asset, right? So a great example, okay, is if you get an old beat junk car, right? And you decide to fix it and you decide to put in a new motor, you do a paint job on it, right? Are you going to charge yourself that money? No. You're going to take the money that you put into the fixed asset, right? So the paint job, the new motor, you're going to add that value to the fixed asset because you're improving that fixed asset. Okay? So let's take a look at an example of how that is, right? So example number one, or example number, whatever example number I'm on January 5th, you purchased a machine for $50,000 on a credit card, okay? And of course, it includes all the fees and things like that, so record the purchase of it. So once again, same exact scenario, but we're going to take a look at it. So I'm recording that I bought a machine equipment on a credit card for $50,000, okay? So again, let's say 4 years later, right, you decided to replace the engine, okay? You decided to replace the engine part, okay? So then it can, continue operating, all right? So instead of buying a brand new one. And of course, on January 28th, you decided to install that new motor, which cost you $10,000, okay? So, which extended the life of the fixed asset by 3 years, okay? And of course, it also increased the value of the asset itself, okay? And right now, it currently has accumulated depreciation of $36,750 and has a book value of the machine is currently $13,250, right? So record this improvement. So once again, right, this is option number one. If I choose to fix my fixed asset, right, how do I go about fixing and depreciating it moving on forward. In this case, I'm replacing the machine with a new motor for $10,000. Okay? So I can either add the value to my fixed asset or I can counter it against my accumulated depreciation. So the first example, I'm going to say I'm going to counter it against my accumulated depreciation. Okay? So in this case, what am I going to be doing here? So I'm going to debit my accumulated depreciation by $10,000 and pay for that fixture for $10,000. Okay? Now let's see what happens and how does it affect my depreciation table. In this case, right, this is where we're at, right? We're at the 49th month, okay? Right now, my accumulated depreciation, as you can see, is $36,750, right? And my book value is $13,250. So by journalizing that very journal, right, of that $10,000 fixture, right? What happens is that on my actual fixed asset depreciation table, this is what's going to happen. I'm going to end up replacing this accumulated depreciation because I am adding it to or countering it against my accumulated depreciation, meaning I am adding the value back to my asset by decreasing my accumulated depreciation. So how much am I going to decrease it by? $10,000. So here I'm going to have to recalculate this the very last month only, okay? That is 26, now it's 26,750, and that had added $10,000 to your book value. Okay, just like that. And then what do you do from moving on forth? You continue your depreciation exactly how you have it right here, right? Using the same exact numbers, because here I didn't increase the cost of the value of my asset. Even though I extended the life by 3 extra more years, that's just something I have to keep in mind, okay? It does not change anything that I've already calculated, right? Because think about it. It's been 4 years of depreciation. Why would you want to have to go back and fix everything? No. It's what's done, it's done. So what you have to do here moving on forward is you start continuing depreciating your fixed asset the way it should be. Okay? So that means for the 50th month, you're still going to have the same numbers. You're going to depreciate it by $750, and you're just going to continue. But this time, your accumulated value is different, and that's what's going to produce your book value different. So this is the easiest one method that you can do that doesn't require you to do too much. Okay? So in this case, any questions here?
No, we're good.
Okay. So now, what happens if I decide to increase my asset cost instead? Okay? So same exact scenario, but this time, instead of recording it against my accumulated depreciation, what happens if I actually change and add that value to my fixed asset? Okay? So here I record that I put an extra $10,000 into my equipment, and here's the cash, right? What happens when I do that? So unfortunately, this is what's going to happen. Since my depreciation is currently straight line and it's currently recording it at $50,000 and has a useful life of 5 years, I have to actually replace those values because now my asset cost is $60,000 now. Okay? It's $60,000 now. And my estimated useful life is now 8 years. Okay? So therefore, what do I have to do? In this case, unfortunately, yes, you have to go all the way back and find some way to be able to adjust your accumulated depreciation to what it should be. Now, of course, with the beauty of Excel, you're able to produce those numbers pretty quick. So that's exactly what you have to do. You're going to have to unfortunately go back through everything because now your book value is not 13,250 anymore. So you're going to actually have to recalculate everything manually until using the new values, right? So in this case, I'm at 60,000 with my asset cost, right? Asset cost by the salvage value is now going to give me a basis of 55,000 now, right? And then of course, I'm depreciating it over a span of 8 years now. So that means it's going to be 1 over 8 years instead of 1 over 5 years. So in this case, it's 12.5%. So in this case, right, I do have to calculate it. And every month now, I'm going to depreciate by $572. So less. And when I get there, that means when I process the next month, this is what happened. I racked up an accumulated depreciation of $28,073.08. So unfortunately, yes, that means I have to go back in my books and fix everything in the past to get me up to date to where I need to be. Okay? So that when I do my 50th month, it's going to be recording using the new additional numbers that you have, and it's going to continue on from there. But notice this, my book value has increased significantly, right? So that is how we would depreciate it if you decide to increase it by the asset cost. Okay? All right, any questions there?
Well, we're good.
Okay. Next one is going to be exchanging your fixed assets. So, yes, of course, when we have our used assets, we do have possibilities where we can exchange them. Okay. So, oftentimes, mostly these opportunities arise, especially to dealerships, right? Auto dealerships often will offer you, hey, I will give you a trade-in value. You trade in your used car, we can get you a new car, etc., right? Now, in this case, right, what are we doing here is we are trading out our old equipment for newer equipment, okay? And of course, we're going to also be trading in, okay, our fixed assets for another fixed assets. Now, usually these fixed assets that you trade out for, it's up to you. If you're choosing to trade like a car for a car, usually that's much more easily done. But if you're choosing to trade in, for an instance, let's say I'm going to trade in my car to buy a machine, then that's going to be a whole different story. It's ideally the same idea, even though if you are going to be doing the trade in value, the journalizing, it's not going to be different, but for this example here, I'm going to use a car to a car. All right, it's much more easier to understand, but at the end of the day, the concept's all the same. Because if you choose to take your car to go buy a different fixed asset, of course, you can do that. Just make sure that you are aware that you're trading in an asset for a different asset, okay? Now, of course, if you choose to do so, right, we have to consider when exchanging between fixed assets that we must consider the fair market value of our fixed assets. Now, what does that even mean? Well, we always talk about how you have to go get your fixed assets appraised because right now, our books, we say it's worth X amount of dollars, but is that really true? That's because that's how we calculate it. Anybody can calculate their fixed asset and depreciate however they want. So, especially for sole proprietors, right? We're saying, oh, I barely used my car, so therefore I barely depreciated it. So, in this case, it's worth a lot of money. Well, that's not actually very technically true because as soon as you drive off the parking lot, you already depreciated your car by $5,000. Mm-hmm. Just by driving off the parking lot. So you already lost $5,000 right out the door. Okay, so even if you try to return the car and buy back the car back value, you're automatically going to lose that $5,000 because you started driving the car. And when you drive your car, right, you wore out all 4 tires, you use the machine, right? And everything that's in the car, you use the gas. It's you lose at least $5,000 by driving off the parking lot. So in this case, that is what they tell us. Now in our books, we don't record that $5,000 depreciation right away. We record it however we find it best to for our company, right? Based on what we're depending on what depreciation method works best for us, right? But we don't recognize that immediate depreciation. So in this case, we have to get our car appraised, okay? Meaning take it to the dealership, they're going to take a look at your car, and they're going to give you a quote on what the fair market value is. So that's why it's important that you understand what the difference between fair market value and your book value is, okay? All right. So for this example, if on January 10 you purchased a small sedan for $35,000, okay, on a car loan, okay, with a down payment of $2,000, okay, so assume that all fees and taxes are included. So record the purchase of this fixed asset. So we bought a vehicle. We paid $2,000 and we took out a loan for $33,000. Now, in this case, once you get your car, the loan is what you're responsible to make payments to, right? Because it's a liability. So it doesn't matter whether you trade your assets or not. The loan has nothing to do with the trade-in value of your car. Right? Because you're still responsible to make that payment regardless whether you dispose your fixed asset or not. Right? So in this case, I bought my vehicle for $35,000. Okay? So I'm going to start depreciating it, assuming that we're going to be using straight line to depreciate this fixed asset. So on the first year of using my car, again, I'm putting in my values here. I determined that it should still hold a value of $5,000 at the end of its life of 10 years. So here you go. So 30,000, 0.10, 3,000, and so forth. You for driving it for 1 year, you depreciate it by $3,000. So now my car is worth $32,000. Okay. So then on December 28, which is the same year, okay, the car dealership, okay, offered to trade your used sedan for a brand new truck for a fair market value of $30,000, okay? And of course, you go to an appraisal, okay, to the dealership to get an appraisal to get a fair estimate of the fair market value for your sedan, okay? So in this case, which was quoted for $30,000. So that means your car has a trade-in value for $30,000. Okay. So let's go ahead and record this. Record the loss on this trade-in value. Okay. So in this case, since you're getting rid of your car, right? The first thing you got to recognize is how much was the accumulated depreciation of your car? Well, we only used it for 1 year, so that's $3,000, okay? We also have to actually get rid of your fixed asset. That should be backwards. You should get rid of your asset first and then determine the accumulated. So in this case, I know for a fact that my car is worth $35,000, right? Because that's what I have it in my books. I've already used $3,000 worth of it. So right now, my current book value is $32,000. Okay? I end up buying a truck, right? I traded in the value for $30,000. Right? So therefore, did I get a loss or did I have a gain? In this case, I definitely lost value, right? Because in my books, I said my car's worth 32,000. It got fair market valued and appraised at the dealership for 30,000. So I lost $2,000 out of it. Okay? And that's how you trade in your fixed asset for another fixed asset. Okay? Any questions here?
No.
Last but not least, if you have no other option except for dumping the your fixed asset in a recycle bin, this is how you properly take it off of your books. We call this abandonment of fixed assets, right? So in this case, for any reason that you decide to leave your fixed asset and it has leftover salvage value, this is what happens when you do it. All right, so example here on December 31st, okay, you drove your truck, excuse me, to the end of its useful life, okay, of the 10 years, right? And of course, it had a salvage value remaining of $2,000. Okay. And of course, you originally traded your sedan for this truck, okay, that was valued at $30,000, okay, but you decided to abandon this truck at a junkyard, okay, so you drove it all the way to the ground, and now it's not worth, no one wants to buy it, so on and so forth, right? So let's go ahead and write this asset off of our books. So you're gonna determine number one, the total value of that truck. We already established it was worth $30,000, right? We also have to go ahead and calculate how much accumulated depreciation we have taken off of it at the end of its life. So in this case, we racked up $28,000. So therefore, because you had a salvage value of $2,000, you're going to end up taking that $2,000 and taking it as a loss. Okay? Loss on disposal of assets. Straightforward. And now you don't have that truck on your books anymore. It's completely gone. Okay? Now, of course, that doesn't, you still have to keep a record of this because it's very important to the IRS that you have taken a loss. Okay? That you got rid of your furniture. All right? But at the end of the day, if you didn't pay your loan off, again, you're still responsible to make payments to your loan, regardless whether you abandon or use your fixed asset or sell your fixed asset, right? You're still responsible for that loan. All right, so that is it when it comes to disposing your fixed assets. Any questions?
No.
Okay. So here's a section that I think that this is important to know because in this case, it does have to deal with purchasing your fixed assets. We call this goodwill, okay? And what happens when goodwill is part of your system and it pretty much loses its value. Well, what is goodwill to begin with? Goodwill derives from acquiring another business. Okay, when you decide a business decides to purchase another business, sometimes you can have goodwill arise from it. Now, what is goodwill? Goodwill could be in terms of some kind of investment, right? You're buying the brand name of the business, right? Because you have hopes that this business will turn around your business, right? And gain a profit out of it, okay? Now, this is very, very, very common for a lot of businesses because, again, there's a bunch of small businesses that are looking for investors, right? And those investors might own their own company. So what they're doing is they're acquiring a bunch of different companies. So again, you can always refer this as a hostile takeover, any kind of business agreement, a partnership. But usually these types of businesses, right, you are acquiring the entire business itself. Okay? And what we have to do is, well, when we purchase the value of the other company, we have to take a look at what their book value is and what when we appraise it, what the fair market values are. And we're going to have to determine whether we gained out of this sale or whether we lost out of this sale. Okay? So in this case, right, the example here is that company ABC wants to purchase company XYZ. So whether company XYZ exists or not is up to a company ABC, right? ABC can continue the operations of XYZ in hopes that it becomes a company of its own. So in this case, here is company XYZ's book value on their balance sheets, right? They have cash, they have an accounts receivable that's uncollected, and they have inventory, and they have a few fixed assets, and of course, they still have a loan, and they have a total equity of $82,000. So in this case right now, it currently has a book value worth of assets of $132,000. Okay? So that means company XYZ must go through an appraisal property to get the fair market value of their fixed assets, right? So now we know what they have on their books, right? This is what they've been recording for their company. So let's see what happens when we actually go through the appraisal process, right? And determine the fair market value. Now, in this case, cash obviously will not change its value because cash is already in its simplest form. There's nothing else there. Your accounts receivable, same thing, because it's money that your customers owe you. It will not go up in value. However, your inventory has also gone up in value because you can sell your inventory for a higher price, right? And your fixed assets, you can trade them out for a higher value, right? And of course, you actually found out that you had a patent. And of course, your loan is going to be whatever your loan is, right? So in this case, I end up getting a fair market value of $161,000. Okay? So this is what when I went to the appraisal, right? My current books is $132,000, right? But when I went through the appraisal process, it's actually telling me that this company is actually worth $161,000 now. Okay? If I were to purchase it. So how do I go ahead and purchase my company? So then what happens was it ended up going on June 30th that we end up paying $200,000 to purchase company XYZ. Okay? And so how do we record that we acquired company XYZ? So what happens is you're going to acquire all the assets at fair market value. Okay? From XYZ company. So in this case, here you go. I drop it all in there. That's $162,000. I also have to pay for the loan, $50,000. So in this case, I end up, because I pay $200,000 because I'm investing my money into this company. I believe that I am buying the brand of this company, and by acquiring the fixed assets, I'm going to turn this company around and hope that it will generate me revenue. So in this case, I purchased my this business at a higher price because I have hopes that this company can generate me money. So therefore, I received goodwill. So goodwill is intangible, right? Because I just created invisible value to a company that I don't know for myself is going to give me money or not. I have hopes that when I invest this money into this company, that it will turn around and give me money, right? So therefore, I created goodwill, which is also, maybe it's good faith, or it's your hopes that this is the investment that I am investing into this company. Okay? So therefore, I gained $39,000, right? Because remember, the book value was 132, the fair market was 162, or so 161. So therefore, I'm going to gain goodwill for $39,000. Right? I'm creating invisible value for this company. Okay? Now, as we go ahead and understand that now that we added that extra value to a company, eventually over time, that value will lose its value slowly. Why? Because if that company does end up building upon itself, right? Your value into that company is not going to hold because it's either it's building up or it's slowly going down depending on what your business is. So in this case, goodwill can become impaired. Okay? Because we're hoping that XYZ company, right, will generate enough revenues and generate enough money to become successful on its own. So in this case, right, we're going to go ahead and test to whether or not my goodwill has been impaired or not. So again, so when we're looking at the value of when we purchase the XYZ company, that it should have no reason to amortize over the life of the asset, right? So in this case, so we're gonna look at goodwill, because realistically it should be adjusted every end of the year, right? Because we want to make sure that at the end of the day it's going to lose its value because of, it's our investment to the company, right? We're hoping that the company can build its brand much and become stronger, right? So causes for impairment is when the fair market of the value of the fixed assets that you purchased previously have significantly increased in value. Okay? So now we're going to go ahead and test if goodwill has become impaired. Okay? So how do we test that? Well, we're going to compare when we purchased our company versus what it is right now. Okay? So right now, right, the fair market value of company XYZ right now it is worth $175,000. Okay? We purchased it at $161,000. So in this case, we have to test the impairment of goodwill for $14,000. So here, I already see that my company has increased in value. Okay? I originally bought it low, and look at that, now it's worth high. So in this case, we need to test this $39,000. Okay? $39,000 is what I originally had for goodwill. I'm going to subtract the difference between the fair market values, and I get $25,000 loss on impairment. Okay? All right? And that's how you test for impairment. Okay, any questions here? This is not something I want you to strictly know like 100%, but I do want you to know it is a common practice, because think about it, right? There are way more smaller businesses that exist right now. However, those small businesses, they cease to exist, and they need to have someone to go ahead and invest in them, purchase them, take a hostile takeover, because at the end of the day, we're living in a world where it's a lot of competition. If you can't keep up in the business world, you're going to eventually have to exit out of the business world. So in this case, that is exactly why a lot of companies buy each other out. Okay, example, right? Toys R Us, if you remember them, they closed, and guess what? somebody bought them out. So now they have very, very, very few stores that actually are still open. But because the company that bought them out isn't someone who is, a very large company, they can't reopen all the stores that they closed out throughout the United States. So that is going to be an example right there where someone does a hostile takeover or someone buys the company, right? And they're not investing, they're a different company who buys another company, right? So Google buying Facebook, right, is an example. They're taking a hostile takeover, just like how Google purchased YouTube as well. All right? It's a hostile takeover. And what they hope to get out of YouTube and Facebook is they're generating much more income. So that's a great example of a hostile takeover where it's a common business practice. Okay? And that's, like I said, you don't really need to know this, but I just want you to know this particular part, that where does goodwill come from? It comes from acquiring a bunch of businesses and adding invisible value, okay? And what do I have to do every year that I continue doing the operations of my business, right? I have to adjust my goodwill because it can lose value due to impairment. Okay? Any questions? Excuse me.
We're good.
All right. So, like I mentioned, that small section for 11.6 is good to know information. However, I rather you focus more on 11.5. Okay? So 11.5, right? Let's dispose our assets. Okay? So, starting with question number 1 here. Okay? So here's your first table here. So question number 1. You decide to purchase a couch for $2,485, which includes all fees, okay, with a salvage value of $150. Okay, and its estimated useful life is 7 years, and you put this couch into service on August 25th, 2020. Okay, and assume that the adjustment entries are going to be made at the end of every year. Okay, journalize the purchase of the furniture on account. So first, let's go ahead and acquire the fixed asset. So in this case, how much is how do I journalize the purchase of my fixed asset? So number 1, we purchased it on August 25th for how much?
$2,485.
Okay, so here it's August 25th, 2020. Okay. What did we buy? We bought a couch, right? Couch is considered furniture. For 2,300 and, was it 85?
2485.
Yeah, 2485. Excuse me. 2485. So I purchased it on an account. So how would I record my credit?
Would it be accounts payable?
Okay. Good. So now I acquired my couch. So let's see what question number 2 says. Question number 2 says depreciate the fixed asset for 3 years using straight line. Okay? So here's the table above here. We know that we bought a couch. What was the value of my couch?
$2485.
Excuse me. $24.85. Okay. How much was my salvage value?
$150.
$150. What is my estimated useful life?
3 years.
Well, estimated useful life.
That's 3 years.
Well, no, I'm asking you to depreciate only the first 3 years.
Oh, 7 years.
It's got 7 years life on it. And when did I place this asset into service?
The 25th.
The 25th. So what if I'm doing this at the end of the year, December 31st, right?
Right.
When do I start depreciating my asset if I put it into service as of August 25th?
September.
September. Okay? So, all right, so let's go ahead and depreciate for the first 3 years. So, what's my depreciation basis going to be?
The 2485.
2485. And this is straight line.
Okay, you're gonna figure out the rate, right?
No. We're still on the basis.
Okay. Yeah. I got 2,340.
Okay, so I'm going to take my asset cost and I'm going to minus my salvage value of 150. So your answer is not correct there. Okay? And that's that's going to give me 2,335. Okay, you were off by $5. Okay? So there you go. That's my depreciation basis. Good. What's my rate? This is straight line. What's my rate? How do I determine what my depreciation rate is?
Okay, well, it be you, because what I'm doing is I got 1 divided by 7, and would it be times 2?
That is double declining.
Okay. So if I'm using this, I got 0.14.
Good. But this one is not just 0.14, it's 0.14288.
5, 7, 1, 4, all the way down.
Okay? This is straight line, so therefore I don't need to do it twice as much, right? Because that's double declining. Okay?
Okay.
So in this case, right, let's go ahead and solve for what my depreciation expense is for the first year. So I'm going to use my equal round so I can get a rounded number.
I got 333.57.
Now, is that true for the first year?
No.
No. Why?
So you put it in service
Mm-hmm.
on the 25th.
Mm-hmm. So how much can I depreciate this asset for the first year?
Okay.
How many months can I depreciate?
1 month?
Well, why only 1 month? You put into service as of August 25th, and you're doing your depreciation at the end of the year, December 31st. How old is your asset?
4 months.
4 months. So therefore, you can only depreciate 4 months, right?
Right.
So in this case, how do I figure out what that 4 months is?
So I get 0.333333.
Okay, and what are you multiplying that 0.3333 by?
Uh, the depreciation basis.
Not the basis.
Okay.
You're going to multiply that, right? Because you only want to know what 4 months out of the year is for the depreciation expense, right?
Right.
Because this right here, this $333.57, that's for the whole year.
Okay.
So you're going to multiply that the 0.33333 to the depreciation expense. And what do you get?
Okay. I get $111.19.
Good. So then, what's my book value going to be?
$2,223.81.
Good. All right. So let's depreciate it for the second year. What's my depreciation basis going to be?
Uh, the 2,373.81.
No.
It's going to be the same,
It's going to be the same as as all of this, right? So in this case, it's
right?
my asset cost minus salvage value. Good. What's my rate?
I believe the rate is going to change.
Why would my rate change? What's my formula for my rate?
Oh, okay. It's going to be the same rate.
It's going to be the same rate. Okay. So then, how do I solve for my depreciation expense for the second year?
$333.57.
Mm-hmm. What's my accumulated?
I got $444.76.
Okay, so then what's my book value?
$1,890.24.
No.
Not
So you don't take your book value, you take your asset cost of 2,485, and then you subtract your accumulated.
okay. Okay, I was doing the accumulated basis.
Okay.
Okay, 2040 24.
Good. So then, what about my third year?
Okay, the third year is going to be the same.
Okay.
Okay, 33. A cumulated would be $778.33.
Good. So then, what's my book value?
$1,767.
Good. There you go. So we depreciated for the first 3 years. Okay. So then number 3 says we're gonna record the adjustment entries for 3 years. So let's go ahead and record the adjustment. So again, December 31st of 2020. How am I going to record my depreciation?
Depreciation expense.
Okay. For how much?
111.19.
Okay. And what's my credit account?
Accumulated depreciated
Good.
depreciation.
Good. Okay. What's my journal going to look like for the next following year? So December 31st of 2021.
Accumulated depreciation. I mean, depreciation expense.
Good. So how much was the value for the second year?
Uh, $333.57.
Good. And then let's record it for the third year. So December 31st, 2022.
Depreciation expense and accumulated depreciation.
Mm-hmm. For the same exact amount. Okay? Good. All right, question number 4. If on June 30th of 2023, When did I put the asset into service? 2020. Okay, I miscalculated. Sorry. This is supposed to say 2022. All right, so in this case, on June 30th of 2022, okay, you decided to that you wanted to change the interior design of your store. So, of course, you decided to sell your furniture. Oh, no, I was right. Sorry. You decided to sell your furniture in your store, okay? So, you're going to depreciate the remaining use of the fixed asset and then journalize it. So, in this case, right, I used it up to June 30th, right? So
Right.
far, I've already accumulated how much? So, in this case, on my 4th year, how much did I actually use it for? If I decide that on June 30th, I'm going to sell my fixed asset. So how much did I actually use it up to this point?
Uh, 6 months.
You used it for 6 months for the 4th year, right? So in this
Right.
case, so now let's go ahead and calculate that. So what's my depreciation basis?
It will still be the same.
It'll be the same. The rate will be the same. Now here's the difference. I only need to depreciate this asset for 6 months. So you could divide your depreciation expense in two, because I'm only going to depreciate for half the year, right?
So it'll be 0.5.
0.5 times the depreciation expense.
$166.80.
I got 79 cents.
Nine.
Okay, good. So then what is my accumulated depreciation here?
$945.12.
Good. So what does that give me a book value of?
$1,539.89. 89 cents.
88 cents, because it's 12 cents.
Okay, 88.
Good. So now let's go ahead and see what happened on. We have to journalize that last transaction, right? So in this case, June 30th of 2023, right? We're on the next year now. What are we going to? How do we journalize this last depreciation for the 6 months?
Depreciation expense and accumulated depreciation.
For what amount?
166.79.
166.79. Okay.
Uh-huh.
All right. Last question here says, then on July 1st of 2023, Someone purchased the couch from you for $1,000 cash. Okay? So let's go ahead and record the loss or gain on the sale of your furniture. So, okay, so what is the rule? What do I have to recognize first? If I'm trying to get rid of my asset, right? I sold it. So in this case, it's July 1st of 2023. Okay? So how do I get rid of my fixed asset?
Okay, well, the first one would be cash, right?
It will be cash first because that's exactly what we sold it for, right? We sold
Right.
it for cash, right? How much did we sell it for cash?
$1,000.
We received $1,000 worth of cash for the sale of my furniture, so 1,000. Okay. Now, how do we get rid of my furniture?
Okay, it would be a credit for furniture.
Credit for furniture, because that right, I purchased my furniture. Okay. Now, how much did I originally purchase my furniture at?
$2,485.
$2,485. Okay. Now, in this case, what else do I also have to recognize? Because just because I purchased my furniture for $2,485, what else do I need to get rid of?
Okay. Is it the book value?
Not the book value. You're not going to get rid of your asset from the book value. How do you get to the book value?
Okay, will it be the depreciation expense?
Not the
Accumulated depreciation?
It will be the accumulated depreciation. Good. So in this case, since accumulated depreciation is a contra account, right? We use that accumulated depreciation to decrease the value of my furniture. So in this case, I'm going to debit it, right? Because I'm going to zero it out. So what is my grand total accumulated depreciation?
940 $945.12.
Excellent. So then, now we need to determine, did I get a gain or did I get a loss? So this is where you have to take a look at your book value. Okay? My book value says that my asset is worth $1,539.88. And I sold my furniture for $1,000. Did I lose money? Did I gain money?
You lost money.
You lost money. So in this case, loss on disposal of asset. Okay? How much money did I lose?
What was the okay. $539.88.
$5,039.88. Yep. That's how much you lost. Okay? Good. So let's go it. That's the first one, right? You sold your furniture and you lost value on it. Okay. So next question here, right? Question number 6. You purchased a cash register for $566, okay, with no salvage value. Its estimated useful life is 5 years, and it can print up to 25,000 receipts, okay? And you put this cash register into service on January 1st, 2020, okay? Record the purchase of this cash register on an account. So in this case, I bought a cash register on an account. So how do I recognize this? On January 1st of 2020. So January 1st, 2020. I purchased a cash register. So how do I record that?
So it would be the cash register.
Okay?
Okay.
And you bought it
Did
on an account.
okay? Did they purchase it? Was the account paid? Oh, okay. It was paid with cash. So it'd be accounts receivable.
No.
Wait a minute. Hold
The account was not paid with
on.
cash.
Okay. Accounts payable.
Accounts payable. Good. For how much?
Uh, was it 250?
No. Hold on. Accounts payable.
Okay. What's the
You purchased it for $566.
okay? 566.
What is going on? Oh my gosh, hold on. I erased everything. January 1st, 2020. We purchased a cash register. Okay, and it was on accounts payable for $566. Okay? Okay, for $566. Okay? Now it says right here, number 7, go ahead and finish the depreciation table for the last year of the asset. Okay, use double declining.
Okay.
So in this case, what did we buy? Cash register. How much was it?
I think the salvage value didn't have one.
The salvage value didn't have one, but how much did I purchase my cash register at for?
500.
500 and
$566.
$566. Okay? We had no salvage value, like you said. Good. What's my estimated useful life?
5 years.
5 years. And what is the date that you placed into service?
Uh, January 1st.
January 1st. Good. So as you can see, we already completed the first 4 years for you. So just go ahead and complete the last 5 year, the 5th year. So in this case, I'm using double declining, right? Is that what I said? Finish the depreciation table. Use double declining. So what's my depreciation basis going to be?
Is it the 73.36?
Correct. 73.36. Okay. What is my rate going to be?
It'll be the same.
It will be the same, which is going to be the 1 divided by 5 times 2, right? 40%.
Mm-hmm.
Okay. So what is going to be my depreciation expense?
Oh.
Excuse me.
29.34.
You said 29.34?
Mm-hmm.
Okay. So then what is my accumulated?
$521.98.
Okay. So what's my book value?
$44.02.
$44.02 is your book value. Okay. Good. So then, let's see what happened next. Okay. Number 9, on January 1st of 2025, okay, you took the cash register to a repair shop and you replaced some of the buttons, you replaced the wheels on the tape receipt, and you fixed the spring in the cash drawer for $125. Okay, record this fixture and reduce the accumulated depreciation for this asset paid with cash. Okay. So what are we doing here? We fixed the machine, right?
Right.
So how do I journalize that I'm going to add a fixture to my machine? So January 1st of 2025, I paid $125 to fix my machine, right?
Right.
And it says right here that I want you to use this and reduce the accumulated depreciation. So how are you going to do that?
So are you gonna add the 125 to the cash register?
Well, what did I say? What did I say? There's two options you can do, right? One of them is to either add the value to the register, or the other one is to counter it against the accumulated depreciation. What did I tell you to do?
Mm.
It says right here, reduce the accumulated depreciation. So where are you adding this money back to?
Uh, the depreciation basis.
Not the depreciation basis. We're not talking about the table right now. We're talking about the problem.
Uh-huh.
I'm going to add this $125 from which account?
Uh, accounts payable.
No, we don't owe anybody any money. Okay, read it again. I want you to reduce the accumulated depreciation.
So it would be the accumulated depreciation
Yes.
expense.
Say that again.
That's accumulated depreciation.
Mm-hmm.
Okay.
And then how did you pay for it?
Cash.
You paid it with cash, right?
Right.
So, how much did I pay for?
$125.
$125. Okay? So in this case, what is going to happen? Because I am taking the fixtures and I'm putting it into my accumulated depreciation. So what would happen then? Okay? So that would be question number 9. Okay? After repairs were made, it extended the asset's life by 3 more years. Complete the depreciation table, okay, with new adjustments. So in this case, right?
Right.
Because, let's see, this is what I had carried from this problem, right?
Right.
Now, in this case, if I added the fixture to my accumulated depreciation, right? And accumulated depreciation, we already know is we're going to take that $125 to reduce it. So what happens to my accumulated depreciation?
It's going to increase.
We're reducing the accumulated depreciation.
Okay.
So in this case, $521.98. And we're going to reduce it by $125.
Right.
So how much is going to be my new accumulated depreciation?
$396.98.
Good. So therefore, what is your book value going to be?
$196.02.
$169.02. Good.
Okay.
Good. So then now it asks me to depreciate the rest of the table for 3 years. Okay? So in this case, I'm still doing double declining. Okay? So how am I going to figure this number out? What's my depreciation basis? Go ahead.
It's going to be 169.02.
Good. My rate?
It's still going to be 40.
Still would be 40. Okay? My depreciation expense?
$67.61.
67.61. Therefore, my total accumulated depreciation is
$464.49.
59 cents. Okay. So what's your book value now?
Okay. $101.41.
Okay. So then what is your book value? I mean, what is your depreciation basis for year 7?
101.41,
Okay.
and it's going to be 40%.
And your expense is going to be
$40.56.
okay. And what is your accumulated?
$505.15.
Good. Giving you your book value to be $60.85. Okay. So last one for the 8th year, $60.85 for my basis. Okay, we're going to multiply it by my rate of 40%. So what is my depreciation expense for year 8?
$24.34.
Mm-hmm. Okay, so your accumulated will become $529.49. So therefore, what is my book value at the end of the 8th year?
$36.31. I
$36. Yeah,
51. I mean 51 cents.
that's good. All right. All right, so that's it for this one. Okay? Okay. All right. So, next set of questions. Questions number 10 through 12 here. So, let's see what happened here. Okay. Number 10. You decide to purchase a truck for $35,870, which includes all of the fees, with a salvage value of $5,000. There we go. And of course, it has a useful life of 10 years and has mileage up to 150,000 miles, okay? And of course, you put this truck into service on August 3rd, okay? 2020. Record the purchase of this truck with a down payment, and you took a loan out for $30,000. Okay? So let's go ahead and record that we purchased this loan or purchased this truck on August 3rd. Okay, so August 3rd, 2020. We purchased this truck, right? We
Right.
made a down payment and we took a loan out for $30,000. Okay, so let's go ahead and record that. So what did I buy?
A truck.
We bought a truck. So that would be first thing that you record in here. Okay, so I bought a truck. Okay. How much was the truck for?
35,870.
35,870. I don't know where. Oh, 30, 35,870. Okay. How did I pay for this?
Cash.
Okay. Okay. And what else did I do? How
And you got loan.
you got a loan, right? You got a truck loan.
Uh,
Okay. How much was the loan for?
30,000.
It was for 30,000. So that means how much did I pay up front?
$5,870.
$5,870. Okay, so there you go. I purchased the truck. Okay. Number 11 says on the first year of December 31st, 2020, you drove 10,000 miles. Okay, so therefore, let's go ahead and depreciate. So, so let's go ahead and fill out this. What did I buy?
A truck.
We bought a truck. How much?
3,000. 30,870.
35,870. Did I have a salvage value? Let's see.
5,000.
We have a salvage value of $5,000. Okay. What's my estimated useful life on this asset?
10 years.
10 years. Okay. And how many miles can it drive?
Up to 150,000.
150,000. And when was the date that I put this into service? So basically, when did I buy it? We purchased it on August 3rd. Okay. So go ahead and complete the table. So what's my depreciation basis going to be for the first year if I drove it for 10,000 miles?
Oh,
Hmm?
will it be 10%?
We're not solving for the rate right now. We're solving for the basis. What's my depreciation basis going to be?
Will you take the 10,000 from the 150,000?
We're not dealing with the number of units that we are driving. We're solving for the depreciation basis right now. How do I solve for the depreciation basis for units of production? It's the same as straight line. How did I do it for straight line?
Would you take it out of your assets, which would be the 35,870?
That is yes.
Okay.
Minus
Your salvage.
minus your salvage value. So what is my number here?
Okay. $30,870.
30,870. Okay.
Mm-hmm.
Now I need to solve for my per unit rate. How do I solve for my per unit rate? It's not the same thing as depreciation rate. This is a per unit rate. I want to know how much it's going to cost me for every mile that I drive.
You still would be doing the 1 over the estimated useful life?
No, it's not the same thing as the other two methods that we looked at, right? It's not the same. It's not the same as the depreciation rate. This is a per unit rate.
Oh.
So, okay, the per unit rate is going to be your depreciation basis, okay,
Okay.
divided by your total number of units that you can produce. So in this case, how many miles can I drive in grand total?
150,000.
150,000. So what is 36,870 divided by 150,000?
I got 21%.
21, not percent. This is 21 cents.
Okay.
Okay, because this is at a per unit rate. Now in this case, if I extend it, it's actually 20.5800. Okay?
Right.
All right. Remember, you need 6 decimal places to get the most accurate answer. In this case, it rounds off after 4. So in this case, if I drove 10,000 miles, how much do I need to depreciate my truck for? If it's going to cost me 0.2058 cents per mile and I drove 10,000 miles.
Will it be 6,353?
No. If I drove 10,000 miles and it's going to cost me 0.2058 cents per mile, how much do I need to depreciate my truck for?
$2,058.
$2,058. Good.
Mm-hmm.
Okay. So, what is going to be my book value?
It's going to be 2,000. Oh, wait a minute. 33, 33,812.
Good. Okay. There you go. So let's see. On December 28th of 2021. Okay, so that was only for the first year. So that means the following year, at the end of December 28th, 2021, your car dealership offers to trade your used truck for a newer truck model. Okay? And of course, you get an appraisal on your truck for a fair market value of $30,000. Okay? And of course, you traded your truck in for that brand new truck, okay, for $30,000. So in this case, record this exchange and determine the whether you got a loss or a gain. So in this case, I drove another year with this car. So I need to determine what my book value is because we only solved for the depreciation for the first year, which is from December 31st to 2020. They offered me this December 28, 2021. So that means I drove a total of 15,000 miles for the next year, for the second year, right? So I need to determine what my book value is first because it got an appraisal for $30,000. So in this case, I need to figure that number out in order to figure out whether I got a gain or a loss. So in this case, I need to solve for my second year. So what's my depreciation basis?
Mm, mm, mm. So would you subtract the 15,000 from the 33,812?
No. In this case, this is units and that's a cost. There's no way you can do that. How do I solve for my depreciation basis?
Okay, is it 2087?
Mm,
20,870?
no. I don't know where you're getting that number from. Are you
I,
taking the book value minusing something?
I'm taking the asset minus in the 15,000.
No, this is a unit. This is in miles. You can't take miles away from a total cost.
Okay.
Okay?
Let's see.
So, depreciation basis for units of production is going to be your asset cost minus salvage value. So, what's your asset cost?
35,870.
What is the salvage value?
5,000.
Okay, so what does that equal? If you're going to take your asset cost minus the salvage value.
30,870.
Yes. Now, how do you solve for the per unit rate?
It would be the same rate.
Yes, it would be the same rate because your depreciation basis is the same and you're dividing it amongst the total number of units. So in this case, you are correct. It is the same. Okay, I don't know why that did that. Okay, so, oops. Here you go. So it's going to be depreciation basis divided by the, okay? Same number. Okay? So then,
Right.
how much is it going to be my depreciation expense if I drove this time 15,000 miles at 20.58 cents per mile? Right? So this time my variable is that I am relying on my units of production. So in this case, I drove 15,000 miles. If it cost me 20.58 cents per mile, how much am I going to depreciate off my truck? So now I'm converting my miles into money.
Okay. It's 87.
$3,087 even. Good. So what's my total accumulated depreciation?
5,145.
5,145. Good. So therefore, what is my book value going to be?
$30,725.
$30,725 even. So, did I gain money or did I lose money? Because my book value is $30,725. And I sold it for $30,000 brand new truck.
You lost money.
You lost money. So in this case, let's go ahead and journalize that. So it is December 28th, 2021, right? What did I do? What do I have to recognize first?
Your truck.
You got to recognize the old truck, right?
Right.
How much was that old truck?
It was 3,800 and 35,870.
It was worth $35,870. Okay, good. What else do I need to what did I get out of it?
A new truck.
You got a new truck. Okay, so I'll put that here. Okay. How much did you get that new truck for?
30,000.
You got it for 30,000. And then second to last. What else is included with the old truck that accounted for?
Loan.
No. That accounted for me representing that I'm using the truck. How do I get to my book value?
Your depreciation,
accumulated depreciation, exactly. So in this case, I have to take that out too because I have this representing that I used my truck. So therefore, since I don't have my truck anymore, I don't need that account anymore. So in this case, how much in grand total did I use my truck for?
$5,145.
Okay, and we recognize how much money did we lose? Hold on. If
720.
Good, $725, right?
Right.
There you go. Okay, you took a loss on disposal of assets. Good. All right, last problem. There's only 2 problems and there's no table that you need to use here. So in this case, I decided to purchase a laptop for $920, which includes all of the fees, okay, with a salvage value of $50, okay? Its estimated useful life was 5 years, and you put this computer into service on March 6, 2020. All right, assume that the adjustments are made at the end of the year, and you used straight line for depreciating, okay, for depreciation. So record the um the purchase of the asset on an account. So in this case, I bought a laptop for $920 on an account. And I'm going to assume that I purchased it on March 6th. Okay? March 6th, 2020. Okay? So, March 6th of 2020. Okay? So, what did I buy?
A laptop.
You bought a laptop. Okay? How did I pay for it?
Accounts payable.
You put it on an account. Okay? How much was the laptop for?
920.
$920. Okay? Good. So then it says here, number 14, at the end of the life of the laptop, okay, you decided that this asset was not worth to keep, okay, and that you disposed the asset at an electronics store and received $10 voucher for your next purchase, okay, at the electronics store. Okay, so you got some value out of it. Now, of course, we're going to record the disposal of the asset and recognize whether you got a loss or a gain, or recognize your loss, excuse me. So again, so your total accumulated depreciation is for $870 and your book value was $50. So, how do I record that I'm just going to dispose my asset at the end of its life? So in this case, at
You
the
do accumulated depreciation.
you do accumulated depreciation. Good. Okay. For how much?
870.
For $870. Good. What else do I need to recognize?
Okay, you need to recognize um the $10.
The $10. Good, right? I'm gonna treat this as a cash voucher, whatever it is, right? Because you're gonna be able to use it to buy something else. So cash voucher. Okay. For $10. Okay. What else are you gonna recognize?
The book value.
Not the book value. That's only to help you determine whether you took a loss or a gain.
Okay.
What am I trying to get rid of?
The laptop.
You're trying to get rid of the laptop. Okay? How much did you originally purchase this laptop for?
$920.
$920. So in this case, did I get a gain or did I get a loss? Well, I already told you that you're gonna take a loss anyway because you're disposing an asset.
Yeah.
But how much is my loss? It's worth $50, right?
Right.
Did I get something out of it by disposing it?
You got the $10 voucher.
You got the $10 voucher. So then how much did you actually lose?
$49.
Your asset is 40 is 50 right now, right? You
Right.
just got a $10 voucher. So how much did you lose?
You lost like $60.
No, 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 no. Right now, your laptop is valued at $50, right?
Right.
You threw it away, so you lost $50, right? But you gained $10 out of it. So
Mm-hmm.
how much did you really lose? You
You
got
lost $50. You lost $50.
your your laptop is $50.
Okay.
You got $10 out of it.
Okay, that means so that'd be 60.
No. Right now your laptop is worth $50.
Mm-hmm.
Because you threw it in the trash, you got $10 out of it. So how much did you gain out of that?
I guess the $10.
You gained the $10. So how much did you really lose?
You didn't lose anything.
You just threw $50 down the trash can. But you got $10 out of it. So how much did you really lose?
$40.
You lost $40. There you go. Good. Okay, because you got $10 out of it. So you got $10
Right,
value
right,
out
right,
of the
right, right.
$50 that you lost. So in
Right.
this case, you got $40 out of it.
Okay.
Okay, and that's what you're gonna recognize here, right? As your loss. You only lost $40 for
Mm-hmm.
loss on disposal of asset. Okay? All right. Good job. Any questions in regards to loss on disposal of assets or disposing fixed assets?